So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. Guys, welcome to another episode of the IRR Real Estate Podcast. I'm your host, Jonathan Cattani. I'm joined today with an awesome guest, Preston Spainhour. Preston is a founding partner of Well Capital, Olympic hopeful in shotgun shooting. Well Capital is a multifamily operator in 418 doors and is partnered with Charity Water, a nonprofit aiding in solving the world's clean water crisis. What's up, Preston? It's great to have you, and I'm stoked for a conversation today.
Yeah, thanks for having me. I'm excited to be here, and man, we've had some great conversations at conferences, so it's good to finally be on.
Absolutely, yeah. So, I mean, you guys have heard me plug this a lot. Preston's also a member of Raise Masters. We met just this last weekend in Denver.
Yep.
I was at Best Ever Conference. He happened to be in town for a bachelor party, which a little bit more fun than a networking conference, but was still great to chat. So we'll kind of jump into it here. I think we'd all be remiss if we didn't bring up your Olympic hopeful in shotgun shooting here. So have you been shooting your whole life? You know, kind of talk to me about what led to that and when you realized you could compete in the Olympics.
Yeah, so I was an Eagle Scout, and that was really my first foray into shotgun shooting. I mean, I joined Scouts at 16, picked up a gun for the first time at 17, and it was one of the last merit badges I did. And then I got the invitation to go train at the Olympic Training Center for a stint at 18 or 19. It was right after I moved into college, and it was just bizarre the way it unfolded. And I think, you know, the coolest thing for me, or two pieces of it that I like to share. One is when you're at the Olympic Training Center, everything's about mindset. And real estate and podcasts were the first time that I really saw the convergence of mindset and business. Before, it always applied only to shooting and stayed in that lane. And then the second piece was just at that level, the cost of training can be upwards of $100,000 a year. And so it makes you look for ways to A, produce high income streams, and then B, create some passivity to that where you can then spend the time training and traveling and competing. So yeah, that's kind of the backstory. And I hope to jump back into it and train full time again soon.
Wow, that's awesome. So you didn't even pick up a shotgun until age of 17. Meanwhile, I've been shooting shotguns since I could pretty much hold one in my hand. So that's awesome. So, I mean, last question on this. What was it that made you realize that, you know, you were actually had a future in this and competing in the Olympics? Were you just that much better than everyone? Were you going against people who had competed at that level and you could keep up with them, or what kind of led to that?
Yeah, so I was a nobody coming into college. I wanted to, well, I expected the University of Arkansas to have this team that was, you know, at the national level because we were an SEC school. And so I trained all summer as if that's what I was walking on campus into. And I had a little bit of back and forth with the president at the time of the team. And I showed up and it was shooting in a cow pasture with cows out there and like one trap house. There, I mean, facilities were lacking. There were only 3 members really on the team when I showed up. And so I just took the program over and built it. And then my first tournament was against essentially the blue chip recruits of that class. And I just had a couple lucky breaks, ended up in a final with the number 1 recruit in the country. And then just kind of went from there. I shot decent enough in front of the right people, and it snowballed.
Wow, that's awesome. That's a really, really great story. And as you kind of alluded to before, because of the rigorous training, it led to you needing, you know, to find ways to, you know, have an active stream of income, but also, you know, passive stream so you could train. So kind of now talk to me how that led to, you know, finding real estate and eventually, you know, being one of the founding partners for Well Capital.
Yeah. So I was lucky and got in the right rooms towards the end of college, and then I made multiple six figures coming out of school. And I bet big on crypto back in 2017, and my portfolio dropped 98.5%. And so I had a lot of people at the time telling me, you know, this is not how you invest and this is not the right vehicle. And I started to question it enough that I just began looking for alternatives. And so I took 2 years off of work, read books, listened to podcasts. Multifamily was a common element between Rich Dad, Rod Cleef. had just got my real estate license. And, you know, the question I always tell people to ask themselves is look at it with the belief, like when you're trying to decide how to allocate time or what vehicle to step into, whether that's from an investing standpoint or just your work, your choice in career, look at it as if you could achieve or attain top 1% in your local area, regional, national, world. And what does that life look like? And I asked myself that with real estate agency, and it just wasn't a good fit. It wasn't, to me, the 20 years of work to become industry leader in Arkansas, just the lifestyle that resulted from that wasn't really what I wanted. And the path to get there wasn't appealing to me. And so that's when we just decided, hey, we're going to be Well Capital. I had a business partner and still have a business partner, Braden Wyndham. And man, we jumped into this probably 4 years ago, and it's just been a blast. I mean, we couldn't have asked for a better ride. And we met so many great people like yourself along the way.
Absolutely. I appreciate that. And the last 4 years really have been a rocket ship in the space, I'm sure, as you guys know. So kind of talk to me about, you know, markets you're involved in, how you got into those markets, and, you know, just your investment thesis as a whole.
Yeah. So currently we own in South Texas, primarily Corpus Christi, Aransas Pass area, and then Houston. And we've recently pushed into the Midwest. So Midwest consists for us of investments in Omaha, Nebraska, Des Moines, Iowa, and then Sioux Falls, South Dakota. I like the Midwest better currently just because of where cap rates are today, just compared to where they're pushing elsewhere. And it seems like the cap rate compression has gradually worked its way up the central US. So first it was Houston compressed, and then Dallas compressed, and then it's just kind of ridden up to Kansas City, Oklahoma City. And so we believe that will continue. And then as far as deal structure, we take two paths just depending on what the deal warrants. One model is more of a 3-year quick flip if it's not an asset or a vintage that we want to hold long term. And that could be due to the property management we have in place, just us believing they're better appreciation plays to put money into, but there's an opportunity at hand that is worth taking advantage of. And then the other model is a 10 plus year long-term kind of wealth building model. And I think one thing we saw in the space, just multifamily syndication, was sponsors are compensated at the exit. And so a lot of people try to speed that exit up. And the earlier you can exit, the higher the IRR is going to be as soon as you exit that reposition phase. And that didn't sit very well with us, just because I think we owe it to investors to put them first. And if that means our big paydays 10 plus years down the road, it just is what it is. And you as an operator, I mean, we need to be able to live, we need to be able to operate these deals and travel and do our job well. But I'm not in a rush to have the big exit pop if that's not in the best interest of my investors. And it's really in our best interest too, as long as you decouple IRR from sponsor compensation. And so we use a cash on cash model, and we just have a straight split with our investors.
Okay. That makes total sense. So I kind of want to get into your cash on cash model here a little bit, but first, uh, are both deal structures, are you finding the same investors wanting in on both, since it's a little bit diverse in terms of, you know, one does have a quick exit, which is obviously going to increase that IRR, and you can take advantage of, especially the appreciation we've had over the last couple of years. So you're finding that both all your investors are typically involved in both deals?
We see a mix. I mean, there are some that straddle the line and do both. There are some that are all about the longer term plays. It's usually younger investors that like that. And then we have a lot of older investors. I would say individuals that are 60 plus are going to gravitate more towards a 3 year, just because they think about lifespan and, how many 10-year plays do I have left? And the importance and I guess, distinction between the two that we try to communicate is there is still an exit of capital in the 10-year play. We want to be able to exit 100% by year 5. We want to see a path in underwriting to do it in 24 to 36 months. So if we see, hey, if cap rates do remain the same, we can get money out in 3 years. If they regress, this is where we're going to be year 5. You still get your capital back, and then you go buy a second passive income stream with the same money, essentially, but you don't have the taxable event that gets kicked down the road. And with the IRR 3-year model, that's going to be more of a, hey, can we find something that pushes into the low to mid 20s in IRR in 36 months and just get in, get out?
Got it. Okay. So a little bit of everything to kind of go around. So I guess that leads perfectly right into now. Talk to me about your cash on cash model and kind of how you structure your deals.
Yeah. So it depends on the market, what the pref is, but there's a pref and then a small catch up for the operator. And then after that, we participate in cash flows just year over year. Once we return 100% of capital, the pref disappears, but the participation up to this point in every deal we've done with that model is 70-30. So we'll do, just for example, a 6 pref, 1.5% catch up, and then everything past that 70-30. 70 to investors, 30 to us. That gives us the ability to participate in the upside of the deal throughout the deal. And it incentivizes us to continue to hold it, which is really what's in investors' best interest. So once we return capital, it's 70-30 on every dollar, and the pref just bleeds off.
Got it. So you're doing the 1.5 catch up annually then, essentially, until.
Yep.
Got it. Okay. And then as you're paying that, let's just say the 6 pref like you use, is that considered a return on capital? So you're using that to actually pay down the capital and return that to the investors through the life of the deal, or you're still waiting for that sort of refinance exit before you're returning capital?
Yeah, refinance is the only return of capital. Everything else is return on and would be, I guess, taxable passive income. So, and we'll wait and execute the refinance once we can take 100% out and net of, off refinance fees and everything else that goes into it. We haven't gotten obviously 10 years down the road yet, but I expect what it will turn into when we poll investors and just kind of put feelers out to see what people want to do. A second refinance is going to be more appealing than a sale if it's a good asset and a good location. And I have no issue with that as an operator because we get to participate.
Absolutely. And especially with the market you're in, some of those more secondary markets, and of course, the Midwest being, it's very much blowing up, but certainly a little bit more on the slow and steady, as opposed to some of these hotter markets like Austin and Phoenix that are just absolutely exploding. So obviously you guys are very transparent with your investors, which, allows them to trust you and trust in this model, which, at least in my experience, is not as prevalent in terms of these super long 10-year holds. Mm-hmm. So I know you're big on like vetting sponsors. What kind of process, what does that look like for you guys? And when people are vetting you as well?
Yeah, I think the important questions to ask are how often will you visit the property? What's your experience in this market? I just from our past experiences, the thing that I think really can cause the most issues on sub 100 unit assets is property management. And so we want to know, have you used property management before, or do you have an industry connection who has experience with this manager? And that's really our buy criteria changes based on property management that we trust in different markets. So Corpus Christi, we would have no problem taking down a 10 unit and just lumping it into a portfolio because we have management there that is effective on a 10 unit asset. If we found a deal in Fort Worth, my manager that I trust in Fort Worth is Asset Living, and they manage 160,000 units nationally. Their minimum is 100 units. So in Fort Worth, we're not going to go below 100 units until we have management in the area that we trust below that. So I think that's the important thing, because that is where you're most likely to go off business plan. And then I would say the other, I guess, deeper than surface level question to ask sponsors is just, where are the fees? What do they consist of? And if it's a heavy reposition, have they done that before? Because that's where a lot of people get bit, is they've only done deals where you walk in and you have 20% of the units renovated and a template to go do the other 80. It's a very different business model to go in and essentially set market precedent on that asset and say, we're going to do $20,000 renos and bump rates $400. I mean, that's a big jump. Your year one numbers are going to be very different than something with a templated construction plan. And that's the background Braden and I come from, is just construction management. So I think year 1 and 2 assumptions and underwriting are really important to understand there.
Absolutely, because I think one thing, especially as people are getting into this industry, it's becoming more prevalent. You're starting to see people who are realizing that, year one cash flow is either going to be non-existent, which is very common, or, maybe 2% at best. And so helping people understand why that is, especially on some of these, like you said, these heavier lifts, which is really kind of what the industry is turning into, is if you want to find these good deals, these one that pencils well, you got to be prepared. And so you mentioned that construction background is huge. So are you guys partnering with people in these markets, relationships that you formed, or do you have an in-house team that kind of handles all of it?
Yeah, so we have construction groups that our property managers prefer to work with, and I found that to be more effective than, we can go out and vet and we can find one who will knock it out of the park on the construction front. If they can't communicate to our property manager, hey, this unit just became vacant, can we have a crew in there in 48 hours? And then when it's rent ready, it gets handed off, then your loss of revenue just on the inefficiencies there is not worth whatever advantage you have on construction management or reporting or anything else. So we've found that first step is identify property management. Second step is ask for their preferred contractors, and then we'll vet their list and pull references and kind of go down that path.
Awesome. Yeah, that's a really great process to have. And it sounds like you guys are obviously well established in these markets. So of course, that's going to help as well, having established relationships. So what kind of led you to these markets? Have you always had an eye for the secondary markets, or just relationships you have from those previously?
Yeah, I think some of it was a byproduct of our deal sourcing process. The route we chose to take was find single family wholesalers, reach out and touch them, tell them we're multifamily buyers. And most single family wholesalers, they don't know how to underwrite a multifamily property. They see 1 to 2 a year, and they have no buyers list for those assets. So if you're the person touching them once a month, then when that deal comes across their desk, you're going to be the one they think of. And it happened to lead us to secondary markets initially. And I think with more exposure to the industry and just cap rate compression and the like, we've just gravitated towards that. And I think it's better for the long-term refi and hold model there's just a little more meat on the bone, and you go in with a better basis typically in secondary markets.
Yeah, absolutely. And that also kind of gives you some of that downside protection too, in case, we do see a correction. You have more of that equity baked in, which obviously is really great, especially for the long-term hold, because, if you're playing that long-term, chances are we're definitely headed toward a correction now, that's safe to say. But even, 5 years ago, we thought we were too. And here we are 5 years later and everyone's like, holy cow. So
yeah, especially
in these acquisitions these days, it's nice to have that baked in there and that conservative underwriting, and you're not just projecting 12%, gains over the next 5 years and your rent increases and whatnot. So
right. Yeah.
Awesome. Well, this is sorry, go ahead.
Well, one other thing we love is in our underwriting, I mean, we're regressing 10 bips a year for 10 years and 3% just baseline market rent growth. Sometimes we'll drop that down to 2, just depending on the market it's in and historical growth. So you have so much more time for the market to help you on a 10-year play versus a 3-year where you're just praying for that, 18% bump that CoStar predicts. And if that doesn't happen, you either don't win the deal or you win a deal that doesn't perform. So we just feel like it's safer all around just to stay out of the hot markets, at least until the market adjusts.
Yeah, absolutely. There's something to be said about just hitting singles instead of always trying to hit home runs. You end up actually probably being a more favorable person on the team than someone who's just always trying to hit home runs. Yeah. So I love that. As a fund manager, that's certainly something that I look for when I've had sponsors and I'm looking for a sponsor to get into a market who's out there, being conservative, finding those good deals. So how kind of along that, how many deals would you say you're underwriting before you're, putting in an LOI or making an offer?
Yeah, I would say we will process 400 deals. We'll probably put LOIs out on 10% of them. And then of that 10%, maybe 2 to 3 deals shake out, if that, but it's probably closer to 1. So 0.25% of deals end up converting to acquisitions.
And then is that just you and your business partner doing all the underwriting?
Yeah, we have help and we outsource some of it. There are things we've done to speed the initial underwrite up and just baseline assumptions we make. And we're going to miss some deals just because we're not so in the weeds initially. But we found just the ability to kind of plug and play and figure out what's worth a deep dive is just a better use of time.
Absolutely. That's very important to sort of have certain rules of thumb that you follow for your model, not always the same for everyone's model, but the ones that you can all agree on, this is what we're going to go for. And like you said, a few may slip through the cracks, but in reality, it's not really going to be anything detrimental. And unfortunately, in today's market, that's kind of just the way things are going to happen. So we're kind of getting close here, and I definitely want to get to charity water. So I know that you mentioned a portion of your guys' proceeds go to them. So let's kind of talk about Charity Water, how you found them, and your partnership and what they're doing for the water crisis.
Yeah. So before we went full-time in real estate, Braden and I both did construction management consulting, and we did all of the hurricane rehabilitation for states, typically 2 or 3 years after the hurricane event. And we'd go in and rebuild the houses and the mobile homes. And so that job, the expectation was 90+ hours a week. And that pushed our multifamily to after hours, which ended up being pretty late. So I think I was underwriting a deal at like 1 a.m. and this ad popped up on YouTube with what I had playing in the background. And it was an 18-minute Charity Water ad. And we can link into the show notes. We've got rights to use it now from Charity Water, but it popped up and I watched all 18 minutes, sent it to Braden, went to bed, and then he woke up the next morning, watched it, and we were both like, okay, this is the cause we're going to give to. And we both started giving on a personal level. And then Braden read the founder's book, and I read it a couple months after, and I was coming up on a chapter that actually talks about doing what we chose to do, and just said, hey, I really think it would be a good idea to build the brand around this cause and take it from the personal to the business level. And he was totally on board and had the same feeling. And then I read this chapter, and it's like, well, if a couple businesses were founded with the purpose of giving to end the water crisis, if just 2 or 3 of those businesses achieve success at scale, that would be enough to really make a dent. And I feel like we've started to do that. So far, we funded three wells have been funded, identified and funded. We have funding out for another 2. We don't know where they're going to be yet, but those will be allocated in the next week or 2. And so 5 wells total, coming up on 1,000 people who have clean water for the first time. And the partnership's just been amazing. I mean, they're a great company, and we get to report on the progress on the well building as we're performing the reposition on the asset, which is neat for our investor base.
Wow, that's awesome. What an incredible cause to give to. And what a fascinating story, right? There you are, just working late. Hear this almost just a sign from the heavens, as to what you guys should be doing. And so if I understand correctly, you give 10% of gross.
Yep. Yeah. Everything gross collections from our sponsor revenue. And so it doesn't affect investor returns at all, but we do want investors to understand the impact that's associated with their choice to invest with Well Capital. And so we'll tie the wells to the projects that are funding them and just report alongside each other throughout the business model.
That's so awesome. And like I said, what an incredible thing to give to. And I'm sure it gives you even more rapport with investors, because it's just that much more incentivizing for them to invest with you guys, because, they know that part of that's going to a great cause. And I'm sure they're even investing outside of that, right to charity water as well. So that's huge. And like you said, we'll certainly link that in the show notes and make sure that we make that available to the listeners as well. So as we wrap up here, we'll get into our final 5 questions. All right. So question number 1, best advice you've gotten from a mentor.
Yeah, I think this one was just to don't be afraid to let off the brake. I think a lot of people are so afraid of failure that they never get started. And I think in this industry specifically, the other one that's really applicable is don't try to hit a home run on your first deal, or there won't ever be one. I mean, as well as I do, home runs are made from understanding the levers at your disposal in this business. And whether it's a debt lever, an equity lever, property management, or a fee you can implement at the property level that most people don't underwrite to. And I think you never get there until you do that first deal. And don't be afraid to be 5 or 10% of your first one and just get in the door.
Absolutely. I love that so much. And so many great ideas never come to fruition because people just don't start. So that's an awesome one. I love that a lot. All right. Second question. So a recent time you faced adversity and what you learned about yourself.
Yeah, we left our jobs, Braden and I both did, and went full-time in real estate in March of this year. And we immediately, I was still making the 2-day drive back to Fayetteville, which is where I live, from South Florida. And we got the call. We realized we needed to swap property management out on a property and construction companies. And we ended up, it's a tough talent pool market from a construction perspective. And so Braden and I both moved. This was on a Rockport deal. And we moved down there, stayed there for 3 months. We had kind of our financial runway built up that we were going to use to sustain the business. And we put that towards housing, didn't charge it to the deal, and just started working. And I think that just solidified for us owning the sponsor role and understanding that investors come first always, even when it's not convenient, it's not to plan. And we tried to, put that into action.
I love that. That's awesome. Okay. And next question, favorite non-real estate or investment related book?
I would say Millionaire Fastlane. It's about just how to vet opportunities, which was part of the reason I landed on multifamily. So it's a cool book.
Okay. That's awesome. We'll definitely link that in the show notes. All right. And so this is probably my favorite question.
Yeah.
So if your personal investor avatar was a Marvel superhero, which one would you be?
I would say Iron Man, just because I think we're really proud of the systems we've built. I mean, we've tried to build the $1 billion portfolio manager systems before we needed them, and he's got a lot of cool tools. So
I love that. That's such a great one. Iron Man's so good. And I mean, systems are the most important part. So I love that. Awesome. And last one, what's the best way for people to get a hold of you and to learn more about Well Capital and even Charity Water?
yeah, so our website, company website, is www.wellcapitalinvest.com. And if you show up on the site, it's got an investor questionnaire that we just use to vet whether or not people are a good fit for who we are and what we do. And then Charity Water has a page dedicated to us, and the best email is probably connect@wellcapitalinvest.com.
Awesome. And again, I will link all of that in the show notes. You can make it super easy to reach out to Preston. Preston, I've enjoyed our conversation very much. I appreciate you coming on.
Yeah, thanks for having me. This has been great.
Absolutely. We'll definitely have to have you on again as our progression continues for both our businesses.
Yeah, can't wait.
Sweet.
Thanks, Jonathan.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.